Hey, welcome back to our BYOB Square podcast when we talk about becoming your own banker, when we share a nice beverage or a nice idea here. Today, we're going to have a conversation about opportunity costs, which is a very important subject to discuss.
Absolutely.
We've all heard the expression, but very few people really understand that. And more importantly, you constantly live in a application of that idea to increase the efficiency of the portfolio or assets you manage in your life. So before we get into that, Josh, I want to recap a little bit of our conversation, and I'm going to be sharing here my screen so everybody can see what we talked about in our previous episode. So
Okay.
why don't you walk us through that?
Previously we talked about the spending habits of the average American household, looking at total gross income after taxes, seeing where those various expenses go, and then essentially what is left over after all those expenses. And we use data back from the Bureau of Labor Statistics in 2022, so it is quite current. And in essence, people live off of 85% of their whole after-tax income. So 85 cents of every dollar that comes through the household is being spent, which is leaving 15% into savings or discretionary spending, which isn't terrible.
Yeah.
And we would like to see maybe the household be more efficient, or that savings be more efficient, or some way to keep this money working for us. Because if we're spending 85% of nearly $80,000, that's a lot of missed out capitalization of that money, missed out return on that money over time. Which is why we love the infinite banking concept and trying to filter our money through that first, so that even when it's being spent, it's still earning.
Yeah. And it's fascinating to look at the statistics, the 15% or the 85% gross income actually, or the net income actually going away from the family or away from the business, right? We know in reality, the statistic is much worse, right? Americans over the long term have been saving around 5%, right? Everything else is going away from their family. And at that rate of savings, at that rate of capitalization, is very difficult to be prepared for, the dangers of a moving market or losing an income or protection in one side. At the same time, also to be prepared for opportunity. What if the deal of a lifetime that comes every week is in front of you, and unfortunately, you're not in a position to take advantage of? So this, I think, is a really important conversation that we want to bring to the forefront of people watching this content. At Factum, when we do our wealth seminars, we talk about uncommon and versus common frameworks, right? It is very difficult to have common savings rate like what everybody has and expect uncommon results. In order to have uncommon results, you should decide that you need to have uncommon savings habits. Our recommendation is always be between 10 to 30% of your income, constantly capitalizing, constantly keeping the money that you earn and flows through your hands, so you can then again be protected or take advantage of opportunities. So that was a great conversation. And today we're going to get more in depth on the idea of opportunity cost. So I'm going to share my screen again here because I want to make sure that we are talking about this definition with a couple details. So I'm gonna ask you, how do you think about opportunity cost? Because I know this is a weekly thought for you in your portfolio, and I'm fascinated by it. So,
well, first we need to understand what opportunity cost is, which definition's on the screen. It's the loss of potential gain from other alternatives when one alternative is chosen. So we made a decision. The opportunity cost would have been, had we made the other decision, what would the cost or gain have been from that other decision? So as far as asset management, and to answer your question, I'm looking at this in terms of investments. And if I'm holding one investment, well, that's my decision, is to hold it. But if I were to sell it and go to the alternative route and buy something else, what would I either gain or lose by doing so? And it's a constant weighing of the scales of trying to figure out, am I in the best position, or could I be in a better position? What is the cost of changing my position? What is the time commitment of changing my position? So there's a bunch of moving parts when looking at this. It's not always just a clear-cut if-then. There's usually some intricacies involved. But looking at a long-term investment strategy or long-term saving strategy, opportunity cost is critical because of the compound effect. Well, if I just keep doing what I've always done, am I going to get where I want to be? Or do I need to assess and make decisions or alternative decisions in order to progress faster or get to my desired goal within time, different things like that. So understanding the pros and cons of different choices, and then what am I gaining or losing by making the choice that I'm making.
Yeah, I love that. And again, thank you for going through that. In plain English, when I translate all the stuff that you're teaching me and that I'm learning from watching you manage your portfolio, is there's always the need for anchoring and comparing to, okay, am I winning? Am I doing the right thing compared to what? Right? And the what is always changing, and the why is always emerging. Sometimes you don't see it, and eventually new opportunities. So having always the humility and the respect for the process to constantly be saying, hey, I love this rental, but compared to what, is it a good or bad investment? At what performance? And always having the ability to see what is it that is around me that I'm not entertaining yet, to entertain the idea of opportunity cost.
Well, and we also have to make sure that the alternative is actually attainable. So if I were to sell this to go chase down some other property, do I actually have a shot at getting that other property? Is it in an area that I really understand? Is it an investment that I really understand? Because it might look good on paper with a limited understanding, but maybe once you really start delving into it, you uncover something where that would have been a terrible decision. So making sure that the intricacies are understood and that the alternative is actually attainable is imperative to understanding opportunity cost.
In other words, it's not a comparison of rates of return alone. It's a comparison of probability, the difficulty, or your ability to acquire the alternative asset, the risk involved. So a whole understanding of the situation to really understand the opportunity cost is really key. Okay, perfect. I'm going to go into the next slide here. So I wanted to bring up the quote. Obviously, we are always talking about the problem. And I think in the problem, Nelson, in a few words, was very brilliant at crystallizing that idea. You finance everything in life you buy. You either pay interest to someone else when you use credit, or you give up interest when you could have earned otherwise, right? So that is always the trade-off we're making. That's always the opportunity cost when we decide to go and use somebody else's money. We're okay with future cash flows to pay them interest and pay the principal, of course, to replenish that money, or when we use our cash. And I bring this up again because I want to talk to you about that idea of using our cash in particular. Most of us understand that cash usually is better than credit because the credit will require additional interest. Most of us don't realize that when we use cash, we're giving up something and there's cost to that capital. So tell me about that. How is it showing up in your investing experience? What do you see among other investors? How can you add more depth to that conversation?
Sure. And I think it's important to separate here the saving side and the investing side, because we save in order to accumulate capital. And then once we have accumulated that security net, that emergency fund, whatever we want to call it, everything beyond that, we then switch to investing. So we don't want to deplete the whole savings egg in order to invest, because then our capital is tied up in something that might not be as accessible in case of emergency, in case of job loss or something like that. So I want to preface by saying that.
I love that.
But second, when looking at now this investment pool of capital, cash is king in investing. And especially in real estate, cash is your buying power. Now, I could either have $300,000 cash that I put into one investment that's $300,000, or I could look at that $300,000 and at 20% down, I have $1.5 million worth of buying opportunity. And that's the difference of paying cash or financing. Personally, I will finance that portfolio. Because if I could control $1.5 million of assets with 20 cents on the dollar, I'm going to do that because I know that that investment is going to outperform the interest cost of borrowing money from the bank. And this is a little kind of anti-infinite banking concept, because infinite banking, we say, well, we don't want to deal with the banks. But when the bank is giving me a 30-year loan on a fixed rate, that is a perfect hedge against inflation. That is a perfect opportunity to control more real estate. You know, if the interest cost is, say, 7%, but my appreciation rate is 7%, well, that's a wash just on that alone, let alone the cash flow, the depreciation, the mortgage buy down, all this other stuff that goes into real estate investing. So if I were to pay cash, my opportunity cost is that $1.5 million of buying power.
Right.
Now, I might have won this specific contract because the seller wanted a cash deal. So maybe I do it and then refinance. But if I go down that rabbit trail, then it's, well, what is the waiting period before I could do a cash out refi and that whole process? So understanding, you know, the pros and cons of cash versus financing, at least in the real estate world.
Yeah.
I will always finance.
Yeah.
And I don't know that I would ever truly want an investment property paid off, because if it's paid off, I have all of that capital sitting there and I'm not leveraging it. I'm not growing my portfolio beyond where it currently sits.
Yeah. I love that. And when you talk about this, you know, I will give you props because you have taken a philosophical stance on what you see the role of that debt, right? It's a tool, it's leverage, you know.
It is a tool.
I would make the distinction when you talk about this, we're also talking about you're not dependent on the bank. Your dependency is not, because you're well capitalized, you have the reserve to cover the debt, right? You're protected if something happens to you. So there's a different conversation there. But as an investor, you understand that the role of leverage is available, and then you manage it responsibly in your portfolio.
Absolutely.
It's a very powerful tool. So I completely respect that. I think for the audience, there's nothing better than getting clear about philosophically where you stand in that range of discussion, right? You can take one position or the other, or there's a range. You know, there's positions in the middle that also will suffice your philosophical view. But more important than that, I want to point out a couple of things you say, because I think is fascinating. I think that understanding that the role of cash is not just the ability to not pay interest is really important. Cash has its value on the opportunity cost side of things when we realize that it is an opportunity for options.
Right.
So sometimes having the cash itself available for the simple understanding that we don't know what opportunities are around the corner that might be even better off to be positioned for is very, very valuable. And in a world where we hear all the time cash is trash, we need to start highlighting the value of being well capitalized and well positioned to take advantage of opportunities. So I love that you brought that up, because I've started to think a lot more like you in that sense. Sometimes the value of the policy, the cash value of my policies is to have the optionality of pivoting at any point in my portfolio and taking advantage of opportunity that from today I cannot see, but is showing up in a couple of weeks.
Absolutely.
So I love that. And the other thing you said is, hey, I am an investor. I am not gambling. I am not speculating. So
Correct.
when I get involved with credit and I use leverage, I understand that the power of these assets that I'm acquiring for 20 cents, you know, because they're focusing cash flow, they will produce more dollars that will cover the debt coverage payments.
Right.
In other words, the value I'm producing is greater than the cost of the capital that I'm incurring. And that is a position from an investor that understands how to manage a tool like leverage. So
absolutely. Yeah. I mean, if the rent's $1,250 a month and the mortgage payment, principal, interest, taxes, and insurance is $1,000, well, that's $250 of cash flow.
Absolutely.
So, you know, as long as I'm not burning through that and living off of that cash flow necessarily, if I'm cycling that back into the whole investment process, keeping reserves for vacancy, keeping reserves for maintenance things as they come up, making sure that that property itself is well capitalized, as well as my available funds to invest being well capitalized. So it's looking at each property essentially as its own business, and each business needs to have income, it has expenses, it needs to have reserves in case there's an issue with the income. So looking at it not simply as a, well, I bought this and now I get to live off the cash flow, but looking at it truly as a business and treating it as such is going to be a much more fruitful and less stressful environment.
I love that. One quick advice, for me as a student of this subject, right? When you put yourself in a position where you control the capital, it also comes with responsibilities. And one of the responsibilities is deciding, okay, what are the reserve ratios that I want to implement for my family or my business? And you can express that in multiple ways. You can say, hey, I'm going to have a certain amount of money, and every dollar in excess of that is now available for me to go and invest. Or you can say, hey, for every property and business I own, I'm going to keep 3, 6, 9, 12 months of reserves, right? Or maybe when you look at it from the perspective of the policies, I'm not going to borrow more than 60, 70, 80%. You need to decide that. Nobody's coming.
Right.
So when you are becoming your own banker, you get both the privilege and the responsibility of being a steward of that capital. So
right. And we have to be good stewards, because if we go under, the government's not bailing us out.
And they shouldn't. They shouldn't. So we're no bank. Let's move forward here in the presentation. There's a couple things. So now let's take it into a practical conversation, and we're going to start by talking about financing liabilities. We're going to explore both sides of the equation. So when we talk about let's finance a vehicle purchase, right? One thing I like to point out, Josh, because I think it's very important. There's a lot of noise in the internet about this. I make two distinctions. You buy something, you buy something, you buy something, has nothing to do with how you finance that. And then there's how you finance that purchase. When you realize that when you buy a liability, a piece of jewelry, your primary residence, a vehicle, you're making that purchase, and that money is going to go to the person that exchanged that good for your money.
Right.
How you finance that is when then you have a conversation about efficiency. So what are your thoughts on that? Walk us through a couple of these items.
Sure. So buying a vehicle, the common ways are either pay cash or get financing, whether it's through the dealer, a credit union, a bank, something like that.
Yep.
The third, for those of the audience who have been following us, we've mentioned this before, is using your infinite banking policy in order to finance your vehicle. And there's pros and cons of every one of them. If we pay cash, then we're not paying interest.
Right.
But the cost is the future possible interest we could have earned
on that money. Yeah.
It's also another cost is now we don't have access to that capital if there was a great investment opportunity.
Yes.
Because it's tied up in the vehicle. Now, could we go refinance the vehicle? Yes, there's ways to get your cash back out, but now you're dealing with that process and trying to still get the opportunity. So,
which somebody else controls that decision, by the way.
Correct.
Yes.
Finance with a third party, so bank, credit union. Now, that's great because we then get to keep the majority of our cash. So now we have access to make those investments or make the purchases we need around the house. Maybe we're short on cash, but we need the vehicle to get to work. So yeah, I probably need to finance it, but the cost of that is now I'm paying interest.
Yeah.
And if we're paying that interest, is it possible that we could pay it to ourselves or keep it in the family? And that's where the infinite banking comes in, is if we have a family banking system. I'd rather go to my dad and say, Dad, can I get a vehicle loan at 7% instead of paying 7% to the bank? That way, the interest is going back to the family. And so in that instance, he could take a policy loan from his banking policies and say, hey, here's the money to go buy the vehicle. Here's our payment schedule. It's all in the family. There's no qualifying. There's no any of the third party financing kind of things. It's the family banking system.
Yeah.
Now that's great for me, but the opportunity cost for him, my dad potentially, would be decreased access to capital for other opportunities.
Yeah.
And that's where he has to then do the opportunity cost analysis of, well, I could either finance this vehicle at 7% to Josh, or is there another real estate deal or something that's going to come along in the next 5 years? Let's say there's a 5-year term on this vehicle. I don't have access to that capital now for 5 years. Yeah, I got the interest coming back, but if he lent me $70,000 for a new work truck, and that could have been the down payment on a $140,000 home, or sorry, more than that. I can't do math right now, Dave. $350,000 home, 20%.
Yeah.
That's a huge opportunity cost, because if that $350,000 home's going up at, let's say, 4%, well, the capital gains is much more than I'm paying in interest.
Right.
So that's the whole weighing of, well, if I lend you money, well, now I can't do that. And the whole balancing act, juggling act of utilizing capital efficiently.
And I'm going to be very specific about why we're bringing this conversation, because what I wanted to point out from what Josh is talking about is that we are not trying to say, you'll hear on the internet, oh, buy jewelry, buy a car with infinite banking and make all your money back or have all your money back. Those statements are inaccurate, because the reality is that when you buy a liability, you buy a liability, you buy a liability. You buy a $20,000 car, you're buying $20,000 car, you're handing somebody else $20,000.
Mm-hmm.
When you use cash, you're going to give up the opportunity to earn money, interest on those 20 grand. If you use financing, you're going to pay interest. And if you use your policy for a period of time, you're going to decrease the available cash value in your policy. Yes, there's benefit at the end to using infinite banking, like we always talk about.
Mm-hmm.
You're not interrupting the compounding of the $20,000, which is the ability to capture that interest that the cash could have earned.
Right.
And if you're an honest banker, you have the ability to repay and amortize that loan and then have more cash available in the future once you make the repayments and capture some of that interest that you're charging. But the reality is that you're still dealing with opportunity costs. The sending the $20,000 away to a third party in exchange for the car is still there. So it is inaccurate to say that, oh, you'll make all your money back. That is not what is happening. It is more efficient as a method to capture the interest that could have gone away with credit or that you give up by keeping the money inside your control.
Right.
And this brings the bridge that I love the most, which is, okay, that is true for liabilities. Let's think in terms of assets, because this is when I think the infinite banking concept becomes the most interest, right?
Well, before we proceed,
yeah,
if you have the cash to pay cash, put it through the policy first.
In an ideal world, absolutely. I want to capture all the potential future earning of that money.
Right.
Absolutely. And again, that's why when we start talking about any of this conversation at the foundation, hey, let's create capitalization in a place in an environment that we own and control, which is exactly what you're doing to manage your portfolio, doing both, right?
Exactly.
Setting the foundation and then also managing the growth of your wealth. So let's talk about this, and it's going to seem like a trick, but obviously the same slide, the same content, right?
Yeah.
The only thing now we slightly change is, well, if it's true that when you buy a liability, it's taking money away from you, right? You're just trying to finance more efficiently the interest cost of that. What happens when you do an asset? Because now an asset puts money in your pocket, right?
Right.
And the asset potentially could actually recover the initial cost of acquisition, which is actually the intention every time we buy a rental property or a piece of real estate. So I'm going to take the screen down, but I want to have a quick conversation, because I think this is at the core of the focus that we want to drive our clients to, is like, think about cash flow generation and financing efficiently.
Yeah, I mean, nothing truly changes as far as the opportunity cost. If we pay cash, we're still giving up the access to capital. We still don't have that nest egg or that lump sum to go buy something else. So, we've foregone that. We've foregone the possible interest earned on that cash. Now, yes, it's invested in an asset that is performing.
Yes.
So it is making us money.
Yes.
Which is the definition of an asset, something that's going up in value, something that's bringing in cash flow. And I would argue it is not the most efficient way to go about it.
Yeah.
Again, going back to leverage.
Yeah.
That's where financing with a third party on an asset likely makes the most sense. Now, still, could I pair that with infinite banking? Could I have my down payment come from my policy loan so that cash that I am investing has filtered through the policy?
Yeah.
That money is forever going up in value. It's forever compounding within the policy. And I'm using that policy loan as my down payment, pairing it with the bank who's going to give me 80 cents.
Yeah.
And I'm putting in my 20 cents to get to that whole dollar. So now I've combined number 2 and 3 here in order to have a more efficient way of utilizing my capital and controlling that asset. So again, it's leverage. It's looking at, okay, I put that money through my policy. That policy has a growth rate year over year. That property that I'm purchasing or that asset that I'm purchasing, I'm going to use some of that cash flow to pay down the policy loan and refuel my bucket, refill that bucket so that I could repeat this process again.
Yeah.
And I would argue that is probably the most efficient way we could go about this is finance as much as you can. And you'll hear the arguments of, well, if I do 20% or 25% down instead of 20%, I'm getting such a better interest rate. Okay, that 0.5% that you're probably getting versus that 5%, that's a fourth of another property
Yes.
to save $50 a month on interest. So that's where my philosophy is the minimum down, have that money come from a policy and borrow the rest from a third party in order to have my money, my capital working as efficiently as possible to control as much assets as possible.
I love it. And that's the perfect segue to the last question I want to ask you in terms of portfolio management and opportunity costs. And again, folks, if you agree or not, I don't think that's the point we're trying to make here, right? I just want you to observe an experienced professional investor have clarity about the criteria they use to build a portfolio, because I think that's the thing that I am most grateful for. Is like, I just get that your conviction and your understanding allows you to make decisions very informed, very confidently. And that's exactly what I'm building for my family as well. And hopefully our clients are getting that same message. So
Love it.
The last question I want to ask you is exactly this. So now when you're thinking about the properties you own, and you're thinking about opportunity cost and the fact that the market is constantly changing and new properties emerge and become available in the market, what are the things that you are using as criteria to say, hey, is my cash, is my capital really working the hardest it could be working? And should I be making changes to properties, to elements of the portfolio to increase my efficiency? So you have a few things here. I'm gonna let you walk through them. So let's have a quick conversation about that.
Yeah, the first two are things that you're going to hear a lot, especially in real estate, and I would argue in the stock market as well. You're looking at ROI, or return on investment, quite heavily. Return on investment is the net investment gain divided by the cost of that investment times 100. So we actually get it instead of a percentage, like the true value there. So if I put in $1,000, that was, or the gain was $1,000, the cost of the investment was $100,000, then I'm making 1%,
right?
Which is not great.
So look, but you only know that comparing that rate of return you just calculated to something else's rate of return and having an apples to apples comparison.
Correct. Now it's important to understand the return on the investment. And I would argue that the net investment gain, we're not just looking at, well, how much cash came in. It's looking at the whole investment. So that's accounting for growth of the investment through appreciation. That could be accounting for, was I able to do cost segregation or depreciation of that? And what is the monetary value of that?
Yeah.
So when we combine the holistic investment, that is a better analysis for looking at the true return as opposed to just the cash flow.
Yeah.
Cash on cash is how much cash is coming back to me versus the cash that I put in. So let's say I put in $10,000 and I'm getting $1,000 back. That is a 10% cash on cash return.
Right.
This is strictly looking at cash flow. It's strictly looking at the tangible money that's coming back. We're not looking at the appreciation, the depreciation, et cetera.
Okay.
So strictly looking at the cash. Return on equity. This is something I think a lot of people don't pay attention to. And it goes back to leverage, because a lot of investors, especially here in the Phoenix market, who have held properties since 09, 10, 11, they have a ton of equity, especially if they haven't refinanced those properties. So they've got a lot of equity and their cash flow probably looks amazing. So let's say, that property is worth $500,000 today. Let's say their mortgage balance is $100,000. So there's $400,000 of equity.
Yeah.
Well, if they're bringing in, $30,000 a year in cash flow on that $400,000 of equity, that is not a truly efficient vehicle. There's a lot of untapped equity that could go get more earnings. So in that instance, I would argue that investor needs to do a cash out refinance. If they want to keep that property, cash out refinance, take that cash, go control more assets. That's bringing in more cash flow. Yes, you're getting now more mortgages, but you're controlling more property. That property is going up in value over time. You're depreciating more, so you've got more tax savings. It's just a arguably a better environment as opposed to being so equity heavy on something for the return. So return on equity is something I think should get looked at least quarterly in order to, one, track the value of the asset, but two, track how efficient that equity is working for you. Projected appreciation, I put projected because it is not something that we can control. I mean, we can influence a property based on its characteristics, its maintenance, forced appreciation. But looking at a whole market area, there's not much you or I can do to make a market appreciate. But it is something that I think is worth looking at, because if we look at a 30-year trend, in order to get a generalized appreciation for an area, the Phoenix market is about 4.5% to 5% on a 30-year basis. So buying something, again, let's use $500,000. If I buy a $500,000 property here, I'm going to expect its value to go up by about $25,000 over the next 12 months based on the historical trends. Now, that's something that I'm going to utilize in order to help track my return on equity, because if I now have $25,000 more of equity, how efficiently is that working for me over time? But I also need to know that in order to look at, my ROI over time and these other things, because that appreciation is important in picking an area for the long haul. And obviously it's an uncertain number, but every market is going to have characteristics where you either know, okay, this area is improving or it's declining. And that's where understanding the local market, understanding the economics, the jobs, the government, what kind of policies are going through in order to see, okay, is this a safe investment for appreciation over the long haul, or is the way that things are getting done here leading it into decline? And we can see that with, say, Detroit. In its heyday, it was phenomenal, and then policies and things like that led it into decline. And now you could buy a property, you could buy a 1,600 square foot property for $30,000 in Detroit,
and you wouldn't expect any appreciation.
And I would not expect any appreciation. So looking at that as appreciation is the icing on the cake, because it's not a fixed number. We don't know that it's going to happen. Like when I sign a lease with a tenant, I know that tenant's paying that number. That is a tangible number. That is something that I can value my investment based off of. Projected appreciation is simply that, it's projected. It's what I expect to happen based on the past, what I expect to happen based on the stuff that's planned for the next 2 to 5 years, in my market right now.
But you're not writing the whole investment on that number.
But I am not investing based on that. It is educated speculation.
Well, again, the last 3 to 4 minutes, a great example of thoughtful understanding of opportunity cost and measures to calculate, hey, is my investment really working at the pace that it should be working? Is my cash working as hard? Again, some of the things that Josh mentioned, right? Return on equity, he would leverage, he is very clear about his criteria and how he would use the tools available to him to go acquire and control property that create more returns. And that's your philosophy. But having this understanding doesn't mean you need to take action in one way or the other. It is just critical that you understand it, because you could be the person saying, no, I don't want to add more leverage. I want to have that equity there. And that's totally fine. The problem comes with not being aware that there's always opportunity cost to every decision you make, because there's always an alternative. And that was, at the end, the objective of this presentation today, which was, when we talk about the infinite banking, you will hear a lot of noise about, oh, you can buy XYZ and make your money back. there's always opportunity cost, and including in the IBC process, using money in the policy has the opportunity cost that money will not be available to protect you or have access to opportunity, right? So understanding that, being aware of that can make you a more confident investor, and also make you just in your family itself, make you have more meaningful conversations about how money moves through your hands, how it's allocated, and to what purposes. So I hope, we hope that this conversation is very useful in sparking creative conversations at home with your business partners. Hey, we should be thinking about opportunity costs. Let's be aware of what we don't see that we don't see. Right? Because in that nuance is where a lot of opportunity lives. So any other parting thoughts, Josh?
Yeah, my last parting thought would be, I'm not saying go leverage everything.
Yeah.
I'm saying make educated decisions.
Yeah.
So your assets are one thing, your own house is another.
Yes.
Should you leverage your house to go buy assets? If it makes sense and you're comfortable with it and your family's on board and you understand the pros and cons of doing so. But I know multiple investors who want to have their primary home paid off, myself included.
Yeah.
I want to have my primary home paid off because I could lose all this and still have my house, my family, my lifestyle. So I do want to state that don't go gung-ho, leverage everything in order to go invest and do these things. You still need to understand the risk. You need to understand the costs, the opportunity costs, the process, the numbers, the intricacies, all of it. And leverage is a phenomenal tool.
Yeah. And, going back to your definition at the beginning, paying off your house has an opportunity cost, which means that equity is sitting there and you're not leveraged. And the fact is that you are okay with that next best alternative not being your decision. You want to stay here. And that's, again, awareness of opportunity cost, which is, again, where I think your confidence in that decision comes from.
Yeah. And it's, that house could be paid off, and that's a huge opportunity cost of, I'm not investing this equity, but what is it giving me? It's giving me the security, the peace of mind, and what is that valued at? So again, that's where you have to understand your own philosophy of investing, your own philosophy of money, of leverage, all these things, and make sure that you're comfortable with the decisions being made.
Absolutely. As always, we're not trying to tell anyone what to do, but inspire people to think, to decide, to take control of their life, hopefully to take control of your banking function. And with that, we're going to close this episode. We'll see you next time.